In this topic, we will go through some normal growth strategies when trading in the stock market. This diagram shows you some capital growth strategies that include short, medium, and long-term strategies in trading and investing financial equities. Growth strategy number 1. Buying the general market include buying and selling exchange traded fund is a strategy that being used by certain trader to gain money in the market consistently. An ETF is a pool investment vehicle similar to a mutual fund that offers investors a proportionate share in a pool of stocks, bonds, commodities, and other assets. The key distinguishing feature of an ETF is that it trades throughout the day on an exchange at a market-determined price, just like a stock. Many exchange-traded funds like Dow Jones or any main market in all around the world have registered phenomenal growth since the introduction. Because of this steady exponential growth, it always been an option for investor as well as trader all around the world to include ETF in their portfolio. Trading and investing in the general market is considered to be safe, less volatile, and give an expected steady return every year. From the past data, one can expect an average return of 10 to 12% steadily investing in the index every year. Next, we move on to a second strategy, which is value investing. Value investing is the strategy of selecting stocks that trade for less than their intrinsic values. Value investors actively seeking stocks of companies that they believe the market has undervalued. The investor looks for stocks with strong fundamentals, including earnings, dividends, book value, and cash flow that are selling at a bargain price given their quality. Value investing always emphasizes on a mentality that sees a stock as the vehicle by which the person becomes an owner of a company. To a value investor, profits are made by investing in quality companies, not by trading. This is a long-term growth strategy as the same as growth strategy number 1. They are seeking around 15 to 25% steady return on investing in the market with good companies without having care about any short-term effect that may affect the company's stock price. Momentum investing is an investment strategy that aims to capitalize on the continuance of existing trends in the market. To participate in momentum investing, a trader takes a long position in an asset that has shown an upward trending price, or the trader short sells a security that has been in a downtrend. The basic idea is that once a trend is established, it is more likely to continue in that direction than to move against the trend. Momentum investing seeks to take advantage of market volatility by taking short-term positions in stocks that are going up and selling them as soon as they show signs of going down, then moving the capital to a new position. Momentum investing can be very profitable. For example, if you buy a growth stock that rallies from $10 to $15 on some glowing analyst reports and get out before the correction, you will earn a profit of 50%. This is not the annualized return, but the return from a position that may have been only a week or a month old. The speed at which an investor could potentially make a pile of money is staggering. Momentum investing usually seeking at least 25% to 70% return within 1 to 3 months holding. It can be longer if the stock still showing that it has potential to go further upward in the long run. They are a derivative because the price of an option is intrinsically linked to the price of something else. Specifically, options are contracts that grant the right, but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. Before stock investors, might make 10% or 20% return on a stock, aggressive options investors could potentially make 100 or 1000 return in the same amount of time. Any investing carries a certain amount of risk. With more return potential, options investing assumes greater risk. So you should make sure you understand the pros and cons of any strategies you are considering before you start actively trading. Anyone who invests in options or any leverage vehicle are advised to realize the risk involved. It is usually not for beginners, as trading options is really risky if the price going against you. It is advisable that you gain your experience and getting expert at normal share price before going into further aggressive vehicle like options for leveraging. As you can see in the diagram, growth strategy number 1 requires less financial intelligence and perhaps a safer vehicle with lower return. As you go along each strategies to the bottom, the higher the financial intelligence needed in order for you truly success in the higher return financial vehicle. Thus, when you just started trading, it is advisable for you to go at least strategy number 3 in normal stocks and shares before you go further to growth strategy number 4.